$1 billion. Just let that number sink in for a second. In the mid-1990s, that astronomical figure was the amount of money generated by a single department of just about 70 people. We're talking about the self-proclaimed rocket scientists working in the derivative products group at the prestigious investment bank Morgan Stanley. If you average that out, it's roughly $15 million generated per person. That was enough to pay the salaries of most of the firm's global workforce of 10,000 employees and still leave plenty left over for some absolutely massive multi-million-dollar bonuses. But how exactly did such a tiny group of 20-somethings build the ultimate money-making machine?
Welcome back to The Explainer. I am so thrilled you're joining us today because we are going to unpack a truly fascinating and honestly pretty wild piece of financial history. We're heading back to Wall Street in the 1990s, specifically stepping inside Morgan Stanley's derivatives trading desk. We're going to explore how highly aggressive sales tactics, combined with insanely complex financial engineering, created unprecedented wealth for a select few, but in the process, inadvertently triggered some of the most historic and devastating market disasters the world has ever seen.
All right, let's dive into our first major piece of the puzzle, the culture shift. Because to really understand how this derivatives machine was built, we first have to understand the environment it was built in. So, back in the 1920s, Morgan Stanley was famous for its elegant, polite, and deeply conservative approach to banking. We're talking fresh flowers, fine mahogany furniture, a very dignified partner's dining room. Their motto was literally, first-class business in a first-class way. But flash forward to 1994. Facing intense competition, the firm went through this drastic, almost unrecognizable transformation. The elegant furniture replaced by cheap particle board. The fresh flowers disappeared entirely, and donut racks were just shoved onto the trading floor for managers who were way too busy to actually stop and eat a meal. That polite culture was completely wiped out by a ruthless, profit-driven locker room mentality. And their unofficial new motto became first-class business in a second-class way. And that visceral, aggressive tone, it was set at the very top. Listen to this direct quote from John Mack, the leader of Morgan Stanley at the time. This was a man affectionately and fearfully known on the trading floor as Mack the Knife. The source text notes that under his leadership, the old, calm banking era was completely dead. Brokers transformed into these highly aggressive millionaires, adopting a predatory mindset. They literally referred to their sales targets and client commissions as hunting. They were using combat terms like blowing someone up or ripping a face off when they closed a deal. If you want to see just how deep this militaristic target hunting attitude really went, look no further than this acronym right here, FISCO. You literally cannot make this stuff up. It stood for the Fixed Income Annual Sporting Clays Outing. It was an actual clay pigeon shooting competition that the department held. As the text points out, this annual event perfectly captured the firm's overarching culture, identifying targets, taking aim, and pulling the trigger. The clients, often completely unwittingly, were the targets. Which brings us to the actual arsenal. What kind of financial ammunition were these brokers using on their hunts? Let's take a look. The weapons of choice were derivatives. Now we all know the basics here. A derivative is essentially a contract whose value is derived from an underlying asset, like a stock or a currency. But here is the absolutely crucial point for this story. On that 1990s trading floor, how these derivatives actually worked was a highly guarded secret. Very, very few people truly understood the complex math behind them. And the brokers used that exact complexity as a smokescreen. It was the perfect way to obscure the incredible risks from their own clients. Check out how brilliantly this illustrates the deception. Let's look at one of their most notorious creations, PERLS, or Principal Exchange Rate Linked Securities. On the outside, PERLS looked incredibly boring. They looked totally safe. They were issued by reputable entities like government agencies or top-tier corporations and presented as standard AAA-rated bonds. But the inner workings? It's like a financial Trojan horse. Hidden inside the fine print was a highly leveraged, extremely volatile casino tied to foreign currency fluctuations. If you bought a normal bond, you got your $100 principal back at the end. Simple. But if you bought PERLS, your payout was tied to this crazy formula, multiplying the US dollar against the British pound and the Swiss franc. If the currencies moved the wrong way, the buyer wouldn't just lose a little. They could lose absolutely everything. Just how ruthless did this get in practice? Well, there's a story of a broker at the firm who sold $85 million worth of these PRLs to an unsuspecting insurance company. The insurance company honestly thought they were just buying safe government bonds. A few weeks later, the currency shifted drastically, and the bond's value just plummeted. The insurance company's financial officer was in an absolute panic, completely unaware they had just taken a massive, leveraged gamble on foreign exchange rates. And the broker's reaction after collecting a massive commission on that disastrous trade? He proudly bragged to his colleagues, practically with tears of joy in his eyes, "I ripped his face off." And they didn't stop there. They took it a step further with something called PLUS Notes. Let's walk through the three-step magic of this financial wizardry. Step 1. Take highly risky inflation-linked Mexican debt. Step 2. Place it into a legally isolated offshore shell company in Bermuda. Step 3. Get the rating agencies to slap a perfectly safe AA rating on the new entity, and then sell it to conservative U.S. investors. It was literally financial alchemy. Through sheer engineering, they transformed high-risk foreign debt into a pristine, top-tier investment. Okay, so moving right along. Who exactly was lining up to buy these explosive financial products? Let's talk about the victims. Internally, the brokers divided their buyers into two distinct camps. First, you had the hustlers. These were shrewd, greedy managers at funds or insurance companies who deliberately used derivatives to bypass regulations. They legally weren't allowed to gamble in the currency markets, but by buying something that looked on paper like a boring bond, they could secretly take massive, leveraged bets. The second group? They were referred to as the widows and orphans. These were the completely clueless buyers. We're talking local municipal investment boards, conservative public mutual funds. People who simply looked at that shiny AAA rating and bought the product without having a clue about the dense mathematical formulas hidden in the prospectus. And the brokers enthusiastically preyed on both groups.
And the crazy thing is, this strategy worked almost too well. By 1996, the global derivatives market had grown to an absolutely mind-boggling scale, $55 trillion. To put that into perspective, as the author points out, that was twice the value of all U.S. stocks combined at the time. Or, if you prefer, 10 times the entire U.S. national debt. It was a massive, teetering tower of financial cards. And as with any house of cards built on hidden risks, it eventually comes crashing down. Let's look at the financial casualties when things finally exploded in 1994. The hidden risks embedded in these derivatives finally blew up in the real world, creating this incredible cascading domino effect. Literally out of nowhere, household names started announcing catastrophic losses. In April of '94, the card maker Gibson Greetings suddenly announced a $20 million loss from unauthorized interest rate swaps. That exact same day, the 157-year-old corporate giant Procter & Gamble announced a staggering $102 million loss on derivatives. But the real climax hit late in the year when one of the wealthiest municipalities in America, Orange County, California, declared bankruptcy. The Orange County implosion is essentially the textbook example of this entire era. Their treasurer, Robert Citron, had been heavily buying complex structural notes, specifically things called inverse floaters. And to make matters worse, he was using massive amounts of borrowed money to do it. It was a strategy that internally was literally dubbed a death spiral. Now, it functioned beautifully as long as interest rates stayed low. But the very moment the Federal Reserve raised interest rates, the inverse floaters lost their value rapidly. The leverage amplified the damage, causing the county's entire multi-billion-dollar investment portfolio to completely implode. Now, what's really interesting when you look at this contrast is the financial reality of the aftermath. On one hand, Orange County sustained a massive $1.5 billion loss, completely devastating their public funds. But on the other hand, the Wall Street banks? Rather than suffering alongside their clients, firms like Morgan Stanley quickly swooped in, seized the county's collateral, and auctioned off the structured notes. In doing so, the banks largely escaped the wreckage entirely. They actually earned huge commissions while liquidating the county's distressed portfolio. And the damage definitely wasn't contained just to the U.S. The fallout spread globally. It played a major role in the collapse of the historic Barings Bank over in London and triggered multi-billion-dollar losses for the Sumitomo Corporation in Japan. Derivatives had officially cemented their reputation as the ultimate financial weapons of mass destruction. Yet, despite all the billions lost, the incredible, undeniable profits they generated meant these complex financial instruments became a permanent structural part of our modern financial system. So we've seen how these products were intentionally engineered to look like safe, boring bonds while hiding immense, volatile risks inside. We've seen how they were sold to conservative mutual funds and state pension boards. So the crucial question you have to ask yourself right now is, are these complex, hidden risks still sitting quietly in your own mutual funds or retirement accounts today? It's a pretty sobering thought, right? And one that absolutely makes you want to look a little closer at the fine print. Thank you so much for joining me on this explainer, and remember, keep asking the right questions. See you next time.